All right, the primary objective of external financial reporting is direct measurement of the value of the business enterprise. The financial statement do not measure the direct value of the business. The reason is in US, the assets are required to be reported at cost. 50 years old cost has to be reported on the balance sheet. Assets are not allowed revaluation in GAAP. GAAP is in IFRS allows revaluation, but GAAP does not allow revaluation. The assets original cost must be shown on the book. This is very strange. So that is the reason the US, the financial statement will not give you the value of the firm. Why? Because the financial statements are showing old, outdated costs. Unfortunately, because that is the law, the regime, the GAAP regime. So it means that is not right. Then if the business is showing 20 years old financial numbers, how can the financial statement show the value of the business? Incorrect. B, the provision of information that is useful. What is the basic objective of financial statement? Provision of information that is useful to present and potential investors, creditors and others in making a rational financial decision regarding the enterprise. This makes sense. It makes perfect sense, and that's why it's the right answer. Why not C and D? It is equally important to know. Establish of rules for accrual liabilities. Financial statement do not set the rules for liabilities. They're already set before the financial statement. Absolutely right. Direct measurement of the enterprise stock price. Again, balance sheet and income statement are stated on historical cost, 20 years old cost, especially balance sheet. It cannot determine the stock price, because stock price depends upon the business current worth, not on the old outdated 20 years historical cost. Next, which of the following is true regarding the comparison of management and financial accounting? Management accounting is generally more precise. Financial accounting more precise. Only financial statement, 5 financial statements. Managerial accounting has a past focus. Incorrect. It has a future orientation. Wrong. The emphasis on management accounting is relevance, and the emphasis on the financial accounting is timeliness. No. Management accounting has to be timely for decision making. Financial accounting, you get financial reporting after a year when the year is closed. Management accounting need not follow generally accepted accounting techniques. Correct. While financial accounting must follow GAAP. That's the true statement. Notes to financial statements are beneficial in meeting the disclosure requirements. Notes to financial statement, they explain what is in the balance sheet and the income statement. Notes should not be used to do what? Describe significant accounting policies. We use notes to do that. Notes are used to describe the significant accounting policies about revenue recognition, etc. This is why the notes are for. Describe the depreciation method employed by the company. This is the reason for the notes. Describe the principles and methods of peculiar to the industry in which the company operates, when these principles and methods are predominantly followed in that industry. That specifically needs to be adopted. Like if I am an extraction industry, it's a unique business. So there are certain peculiar features in my business, so that they have to be represented in notes. That since my business is like this, these are, so ABC is something that must be included in notes. But the correct, or you cannot use correct and improper presentation of the financial statement. Deliberately something wrong in the financial statement, you cannot use notes to correct that. So this is what you can't do. An objective of financial reporting is objective, the purpose of the financial statements. Providing information useful to investors, creditors, donors, and other users of decision making. It makes sense. Let us see. Assessing the adequacy of internal controls. Whether internal controls are good or not, financial statement do not tell you. Incorrect. Evaluating the management results compared with the standards. This is budgeting. Financial statement is not that the purpose, the objective of the financial statement is not the comparison between the standard and budgets and the actual results. Providing information on compliance with established procedures. This is compliance auditing. Financial reporting gives the results of the performance, income statement, and it gives you the financial condition at the balance sheet date. So it means the most appropriate response is A. It provides information useful for investors, creditors, donors, and others. So A is the right answer. Okay, now read this question yourself and give me the answer. Understand each and every word. Absorb each and every word carefully.
C.
All right. The management of the company is analyzing the financial statements of a corporation because the entity is strongly considering the purchasing of a block of the corporation's ordinary shares that would give the entity significant influence over the corporation. I am considering to buy Azil, your company, so that I could have significant control over your operations. I want to buy your company. So which financial statement should the entity primarily use to assess the amounts, timings, and certainty of future cash flows of the corporation? So which financial statement I would see as an acquirer from your set of financial statements that give me an idea about the amounts, the timings, and certainty of future cash flows? Since the focus is on future cash flows, so I would most probably be looking to the statement of cash flows in your set of financial statements. The past couple of years financial statements, including cash flow statement, will give me an indication that how well the business is doing with cash from operations, from investing and financing. It makes sense. Question 6. An entity that sprays chemicals in residences to eliminate or prevent infestations of insects requires that the customers repay for 3 months services at the beginning of each new quarter. Hello? Wassalam. Ji Nadeem bhai, how are you? Alhamdulillah, fine. Alhamdulillah. हाँ इंशाल्लाह बस लगे मैं इस प्रोसेस में इंशाल्लाह ताला. हाँ वो इंशाल्लाह कर लेते हैं, इसी मंथ में कर लेते हैं, विद इन जुलाई इंशाल्लाह. अब अभी वो पहले बना लें पूरे डॉक्यूमेंट्स, फिर दिखा के मुझे फिर कर दीजिएगा, अभी हो जाएगा इंशाल्लाह. नहीं वो जो इशुएंस डेट है वो आजकल की हो, बीमारी उस पुराने पीरियड की बता दें. हाँ और जो प्रॉब्लम बीमारी थी दैट वाज इन द मंथ ऑफ इलनेस, जून में. हाँ जी बिल्कुल ठीक है. ओके 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 ठीक है. वेलकम वेलकम. An entity that sprays chemicals in residences to eliminate or prevent infestation of insects requires that the customers prepay for 3 months services at the beginning of each new quarter. My company sprays insecticides in residential spaces and I need to be paid in advance. Like you will pay in January 1st for the services I will be rendering throughout the quarter from January to March. Okay. Select the term that appropriately describes this situation from the viewpoint of the entity. I have received the money which I have not earned. Unearned income. Income that I have received in advance, like your fee, if I receive in advance, I have not provided you the services. It is on my unearned income. When I deliver the services, it will become earned income. But if it is the case that when there could be an arrangement with the students, sir, first you will complete the whole course, I will pay you at the end. In that case, I have provided all the services at the end of the period. I have earned everything. I haven't yet received. It will be called accrued income. Accrued income. It is called accrued income because I have earned it but I haven't received. Accrued expense is the expense that has been incurred but not paid. Accrued income is the income that you have earned but not received. Likewise, unearned income is the income that you have received but not earned. Does it make sense?
Yes.
So this is basically, it's okay. Now I will explain all these. Deferred income is an income that you have received but not earned. It is also called unearned income. It is also called unearned income. Deferred income or unearned income are the same. Earned income, you have provided the services and you have earned the income. It doesn't mean you have received it. Accrued income means you have provided the services but you have not received the money. And the last is the prepaid expense. This is from the expense side. Prepaid expense like insurance. Insurance is paid in advance for the coming period. So since we're talking about the receipts, it's about income. So out of ABC, it's A. Deferred income because we have received the money but we have not yet served. It is also called unearned income. Moving on, the financial statements included in the annual report to the shareholders are least useful to which of the following? Stockbroker, he will be using your financial statement to recommend which stock you must buy. Bankers preparing to lend the money, they are very much interested because they have to give you the loan. The strength of your financial statements will help him grant you the loan. Competing business, they would be interested to see how well your business is doing so as to compare my performance. But managers in charge of operating activities is concerned more about his operations. He has operational responsibility. He may have interest in financial statement for wage negotiation. But out of these four, he has the least interest. Mind the word, it says least. Yes. So Mustafa Bhai yesterday, he was asking me that I'm sure he's on the lecture today. On the exam, yes. On the exam, there would be a use of the word least, most likely, least likely, but it will not be in the boldface. Like the way it is given here. There will be a standardized text throughout. Your text, the presentation of the questions, the tabulation most closely resemble to Wiley. Remember, the text of the questions, the graphics, the way the table is laid out, it is most closely resembles Wiley software. That's why we do Wiley, because it gives the exam feel. Alright, so the answer in this case is D. An accounting measurement that is not consistent with the going concern concept. The accounting measurement that is not consistent with the going concern concept. Now let us deal with all these things separately. Historical cost, this goes with the going concern concept. Originally what was the asset was on? If the business is going on, you will have to show the assets at the historical cost. Realization, income that has been realized, earned and received or receivable will be reported. This goes fine with the going concern assumption. The transaction approach, every business transaction that results in change in assets and liabilities has to be recorded, irrespective of the fact whether business is a going concern or not. But look at the option D, liquidation value. Liquidation value means the business is not going to continue for the next 6 months. The assets now must be reported at their realizable value, at their liquidating value, liquidation value. In this case, the balance sheet you prepare is called the statement of affairs, and the assets are reported on their liquidation value. So the liquidation value itself indicates that the business is in problem, this is in liquidation. So it means this is not in consistence with the going concern. Historical cost is the going concern. Realization with the going concern, because the credit sales that we have made to our customers will be realized in cash from in the coming future. Transaction approach, but the liquidation value is the situation where the going concern assumption is not appropriate. That's why it's the right answer. So it ends your subunit 1.